Federal Reserve Chairman Ben Bernanke speaking this morning, and he still says that the economic recovery will be frustratingly slow. He must. He keeps repeating this message over and over again. And as long as he says it, why would anyone buy risky assets such as stocks? Well, let's find out from my first guest, Michael Harkins. He's the co-founder of Levy Harkins. Michael, a pleasure. Always great to see you. So if you listen to Ben Bernanke's testimony, you'd think that we were another economy. I mean, based on I understand maybe he can't change the testimony because of one jobs report, but isn't the economy getting better?
The economy is getting better. It's coming from a dreadful place. The labor force participation rate has supposedly plunged, and that's the reason why unemployment is only as bad as it is. It's very unlikely that millions of American workers have actually left the labor force. I don't know how many of your friends got pink slipped and said, you know, the Caribbean is lovely this time of year, and I'll go skiing next year, and I'll come back a year from now. That just doesn't
and I'll do
happen.
that without actually having a job.
Yeah, that just doesn't happen. So the chairman's well aware of that. But as investors, what we care about is profitability. Okay? Of course, we care about the country and the economy. But the profitability of America has been astounding considering how poor aggregate demand is. The S&P index is still reporting its earnings for the year, but it looks like it'll be very close to $100 per share. No one would have guessed that. No one in an economy that sells barely 12 million cars and virtually no houses.
All right, if you take a look at the S&P 500, the companies that are reporting, I think the earnings and sales go somewhere around 8% annual. If this is going to continue, don't you want to be in stocks? I mean, are stocks the place to be rather than bonds? I mean, I was just noting, you know, the 30-year, all right, it's a little bit higher. It's over 3%, but that's a 30-year commitment.
As you know, I think the bond market is about lunatic. I mean, you're taking a tremendous risk, and there's all sorts of worries. But the worry about inflation is becoming much more a near-term worry. On February 29th, Mario Draghi is going to announce the second of his tranches of this thing that's not quantitative easing. We're not allowed to call it quantitative easing. It just looks just like it.
But it looks like it, it sounds like it, but it's not.
It's a 3-year loan program to buy a peripheral debt. The Financial Times, this is not my estimate, it's theirs, but they've been wonderful on this issue. They said last week they thought €1 trillion would get created on February 29th. You'll remember the first tranche was 489 billion euros. €1 trillion is an astonishing amount of money. It's almost twice the size of the Fed's holdings from January 1st, 2008, when this crisis started.
€1 trillion?
In one go, created in a day. Some of us are a little worried about this. It looks like it's getting out of hand.
Do you think that would be a good place to be when they push the button at the European Central Bank? I mean, is it literally going to be somebody that says, all right, let's click on that option on the screen and create $1 trillion? I mean, how did they come up with this number?
Well, this is a speculation from the Financial Times.
Right.
I'm not sure that it's true. But we're all holding our breath for February 29th. And yes, they've taken in the first tranche over 28,000 different pieces of collateral. You mean they actually know what that many different bonds are worth? Nah, of course not. It's not quantitative easing in the German public's mind, but it is in everybody else's mind, and it's an awful lot of it.
It sounds different in German. It always does. Tell me what's going on with value investing right now, because we're going to talk about some specific stocks, but I want to understand, all right, the backdrop for Europe doesn't sound very good, but as you just described, corporate profits in the United States, at least coming from a place where people weren't expecting it, not so bad. And particularly, we keep hearing about the resurgence in the manufacturing world.
Yeah, I mean, you know, you just wouldn't expect Caterpillar Tractor to keep earning more money on less revenues than it had in the previous cycle, but it keeps doing it. McDonald's is going to report tomorrow, also something Levy Harkins owns, and a 5.5% increase in same-store sales is a terrific increase in profitability. And so many McDonald's now are open 24/7, really 365 days a year.
It's where you eat breakfast, right, every day. All right, I give it to you. All right, we've got here to help us understand the opportunity and the risks when it comes to value investing. My guests are Michael Harkins, co-founder of Levy Harkins, Arnab Banerji of Collabrium Capital, former economic advisor to UK Prime Minister Tony Blair, and we have David Winters. He's the founder and head of Wintergreen Advisors. You know, his Wintergreen fund is up more than 5.5% this year. It's outperformed 99% of its peers over the past 5 years. David, well done. You can retire. You can go out on the beach where Michael wants you to hang out. Tell me what's going on with the fund and specifically with some of the stocks and the perspective. Because value investing, I was mentioning, you're looking for some values and you're finding them in this place called Europe.
Yeah, well, you know, Europe, everybody is down on Europe, and markets have been down, so stocks are cheap. I think the prospects are excellent. And, you know, as we know, retail and institutional investors have given up. And
so who's left? If there's no institutional investor in stocks and there's no retail investor in stocks, who's investing in the stock market?
Smart people like you, Pimm.
Oh, yeah, I wish, yeah. So, all right, so tell me about Schindler as an example of the kind of company you've been looking for.
Schindler's an amazing company. They basically are in the elevator and escalator business. They make money on everything going up and down. And it's a business that also capitalizes on maintenance. And it's growing all over the world as the world becomes more vertical. And they're very good people, and they buy back the stock, and it's cheap.
Buy back the stock, you like the people. What about the idea that, you know what, we might be entering a global recession, David? What happens if, you know, economic growth slows? Don't you then have to go back to the drawing board?
You know, the folks here at Bloomberg are still going to want to ride that elevator up to the 6th floor.
I see. All right. You look for stuff that people really want to have.
And also things that almost no matter what happens, you're going to do well. And I think as an investor, we want to win up, down, sideways. And I think there are a lot of businesses in the Wintergreen portfolio and available at cheap prices today that I think will produce superior returns.
Boy, I sense a sale here, Arnab. Tell me about asset allocation for just a moment, because, you know, you've got other things you can pick, right? I mean, you don't have to just buy stocks. You could be buying commodities, thinking commodity prices are going to go up. You could buy bonds if you think the world is going to end. What are you hearing from investors in terms of where they want to allocate their capital?
Well, investors, institutional investors and others have been running for safe havens, and I don't think they're so safe. They've gone into bonds, they've gone into sovereigns, and they've driven yields down to ridiculous levels where they're getting negative returns. This is a fear trade. And actually, I agree with what has just been said. If you can see through that, then you should be picking up stocks that are incredibly depressed. Now, I think there is value in Europe because it's oversold. I think there's value in some of the emerging markets because they're oversold. So I think there's a place for equities. In terms of commodities, yes, we have we're looking at a difficult time ahead of us with some of the major economies slowing. But with the US reasonably stable and maybe China not having a hard landing, and with all the money that is being pumped into the global economy, then commodities aren't a bad play either. So if I had to say, then I would say that some of the darlings of yesterday are where I wouldn't be. Bonds and some of the overvalued safe havens, maybe even some of the staples. I would look towards the things that are beaten up because I think we're near a bottom in terms of the market. The market's discounted it. And I'd probably be holding commodities as well.
All right, he's preaching to the choir a little bit here, I can tell. Michael Harkins coming in, because I know that you got shares of McDonald's, talking about global franchise here. What other kinds of companies? I know that you also in the past have looked at Qualcomm, for example.
Well, Qualcomm is one of the world's great cash generators. There's nothing quite equal to this. Every time you buy a smartphone, whatever you pay for it and whatever type you buy, a company in San Diego gets 3.5% of that entire smart apparatus of all types. And all they have to do for it is open an envelope. I mean, the patents have been argued to a fairly well in Europe, in Korea. Nokia was suing them for years and years and years. All these patent cases are now gone, and you've got nothing but a stream of cash coming at you. It's the ideal for a value investor. And if you adjust it for the cash on its balance sheet, it's selling for something roughly like 13 times earnings. And we love doing that, adjusting for cash, because we want more cash tomorrow.
You want more cash? Well, we all want more cash. All right, David, so you want more cash. Tell me about Anglo-American, because this kind of fits the theme a little bit, right? I mean, this is a commodity play, but it's a special kind of commodity, isn't it? I mean, they do kind of deal in precious metals and
well, yeah, but I mean, and diamonds.
Bit.
And,
yeah,
you know,
like diamonds.
I love diamonds, especially because, you know, people love them all around the world. As people get richer, what do they want to do? They want to look good. And Anglo, we think, is cheap. It's well run. Cynthia Carroll runs the company. She's done a great job. And we think it's worth more than it trades for.
Why is that? Why do you think that the market discounts these big kinds of companies?
I think that, you know, just the fear in the world today is so extreme, and there have been no transactions.
And,
you know.
and 12 years of miserable experience. This is the second worst 12-year period in the history of the American stock market, the Brit stock market. This has been Outside of the Depression, there's nothing been worse. Well, people always take the last 10 or 12 years of experience and project it forever, which is really foolish and universal.
You got to stop looking in that rearview mirror when you drive down the road. Yeah, I mean, it looks like a good idea, but it doesn't end well. All right, we're going to... Well, let's find out what my think tank believes will happen. We have Michael Harkins, co-founder of Levy Harkins, Arnab Banerji of Collabrium Capital, a former economic advisor to UK Prime Minister Tony Blair. That's a mouthful. And David Winters, founder and head of Wintergreen Advisors, his Wintergreen fund up more than 5.5% this year. Arnab, I got to ask you, because I was looking at the pictures of the Greek protesters, and they're not saying very nice things about Germans when I listened into the Greek words. They're also burning German flags. Why are the Germans willing to suffer the ire of the Greek population when they will get nothing in return? I don't even think they'll get a thank you from the Greeks, will they?
Well, they certainly won't get a thank you. Nobody thanks you for austerity, and it's a real political problem. I think there's a bigger issue in that disorderly breakdown of the Eurozone hurts the Eurozone's biggest creditor, which is Germany. One has to understand that whereas for countries like Greece, the euro is too strong, for Germany it has been a way of boosting exports. Now, I'm not saying that was planned. I'm not saying there's anything vile about that, but everyone, Greeks and Germans alike, have a vested interest in this thing not breaking down in a disorderly manner. Can't continue as it is, but it cannot break up either.
So what do you think happens? I mean, all right, you gave me the diplomatic response, but I mean, it's already a disorderly dissolution in Greece, isn't it? I mean, society there, I mean, the joke is that the government has solved cholesterol and traffic problems. There's no money to buy gasoline so that there's no traffic problems, and no one has money for food so they don't have high cholesterol anymore.
Pimm, you're right. It cannot continue as it is. I think this is a holding action. Let's remember that when the Greek crisis first broke, markets were in turmoil. Now we have these pictures on television and markets are absorbing it. Now, what does that tell you? Well, one thing it tells me is that the banks, the contagion problem we have, they have allowed for this. They know that 70% of their private sector debt is going to be written off. That is already reflected in their balance sheets. If you lose another 30, they can deal with that. The real problem is if something happens, if in a disorderly manner in Greece, are we going to see Portuguese bonds blow up? Are we going to see this in Italy? That's when you need a firewall. And there are contingencies. I don't know how strong they are. The ECB is flooding the market with liquidity. There is a European Financial Stability Facility and an ESM that's not properly in place. So long as contagion can be maintained, Greece itself, with 70% of its private sector debt effectively written off on the balance sheets of banks, whether they come to a deal or not, if it goes from 70 to 100, that can be absorbed. The world can take that. The path to that is what we're talking about. And I chose my words with care when I said not a disorderly breakup. I was echoing Angela Merkel. A few months ago, she said she didn't rule out Greek departure, though it's not something she countenances publicly, but she said, I don't want a disorderly breakup. That's the key word, disorder.
Disorderly, adverbial. All right. What's the you know German, Michael Harkins. I mean, there's got to be a very long word for that.
Oh, I'm sure there is. But look, we keep calling this the Greek bailout. It's the misnomer of a decade. It's not the Greeks. Not one of those 11.3 million people are going to see a penny of this money.
They're not going to get it.
It's a bailout of German banks and French and Belgian banks. I mean, Commerzbank is a mess if there's a disorderly trade, which of course is Commerz and Dresdner Bank. Deutsche Bank is leveraged 45 to 1. 55 billion euros in capital, 2.5 trillion euros in footings. It's the continental banking system that's getting bailed out, not the peripheral countries. Just ask an Irishman. Just ask a Greek.
I can hear David Winters in the background thinking, all right, this is going to drive some people to drink and some people to smoke. And I got to think that maybe, just maybe, that has something to do with some of the holdings in the Wintergreen Fund, talking about Reynolds, Philip Morris International. When people get worried, they just indulge a little bit, don't they?
And also, people love chocolate bars. That's why we like Nestle. You get paid a nice yield. The company grows globally, so you have multi-currency free cash flow. And I think the thing which we're all touching on, which nobody wants to utter that word, inflation. Yeah. And, if you print a lot of money, ultimately...
Is that what happens when you print €1 trillion? I mean, you think that maybe the supply and demand thing, there's a little inflation?
Just, food's more expensive.
Yeah.
There's lots of things in our lives that are more expensive. We love at Wintergreen the idea of owning businesses that have pricing power.
Yeah.
Because that's what protects you on the downside. And you want things that people do, Pimm, day in, day out, you know, rain or shine. It's that
let's go.
idea.
All right, we'll go have a bar of chocolate. All right, that's a good thing to do, a little peace offering. All right, thank you very much. David Winters joining us from the Wintergreen Fund, Michael Harkins joining us from Levy Harkins, and Arnab Banerji from Collabrium Capital. Always a pleasure.